I am joined today by Karen Lagasse. A senior loan officer with Northpoint Mortgage, Karen has over 2 decades of industry experience and has weathered many real estate markets. Along the way, she's helped hundreds of people from purchasing their first homes to helping seasoned investors grow their portfolios. She also happens to be my mother and my biggest cheerleader. Karen, Mom, thank you for being in my life and for joining me today on Cupalo Conversations.
Oh, Lauren, thank you. I am so honored to be here and so glad that you thought enough of me, right? To be able to say, come on, Mug, will you want to go on a podcast? And I love listening to them every single week.
I was going to say, well, you watch all of them. It'd be nice if you were on the other side of the fence here.
Thanks, sweetie.
Well, I would love to talk to you today about 2 things. The first is that there's a lot of people in my orbit who are considering going out on their own like I did just a year ago. And I would love your advice. What should they be considering before they embark on this entrepreneurial journey? And the second thing I'd love to talk to you about is some non-traditional loan programs. Before we get into that, though, please walk me through your journey. How did you get into the mortgage industry?
Well, 24 years ago in 2000, your dad and I had a business and we ended up shutting it down. And that summer, I was like, oh my gosh, what do I do? Because I've always had flexibility in my life, et cetera, you know. So somebody I knew was in the mortgage field, and I approached her and asked her, did you have to be licensed? What does it take? And so she introduced me, and my journey began. So it began in September of 2000, and it's been an amazing journey. It's a great career. And it's done very well by our family. So
that's awesome. You've weathered, as I mentioned, a number of different markets. What would you say is the most challenging one to date that you've experienced? Because you've been through 2008. I think this year has also been very challenging for people. And I would love to know, what would you say has been the most difficult one?
Boy, I think this time. So I think we went through an amazing historic refinance in 20 and 21. Was just incredible with rates in the 2s. Everybody that could have, should have refinanced and just took advantage of that. But then what happened is that just like a switch went off. And so at the start of 22, interest rates were just below 3%, hovering like say 2.75, 2.875. And overnight it went to 3.5. So at the start of 22, we entered into the 3s. And then I believe it was March of that year, we were in the 5s. So, and it was scary because all of a sudden people that had qualified to buy homes no longer were able to. The other component of that is not only the high, rates rising, and we have home values. So, I equated when I purchased my first home in 1984, interest rates were just below 15%. House values, though, were 60, 90,000. A really nice home was in the low hundred, like $120,000, $140,000, right? So, but you take a look at that. So combined, right? You have lower earnings than you do today. House prices were much lower, rates were much higher. But you could afford a home, right? You could actually get into that starter home and buy something $40,000, $50,000 for a little cake. That same cake that you could buy in 1984 today is going for $420, $440 in the city of Manchester. It's bizarre. So you have these poor people that are working, and when you have the average median income of being 80, 90,000, you have to have that dual income to be able to just get into a home, maybe start a family, and be able to buy groceries and gas, maybe have a life. So I think what makes this particularly challenging is the fact that so many people want a home. There's been, up until maybe a couple months ago, there's been very low inventory. Starting to see that change, which has been really a breath of fresh air, to see houses almost daily going on the market. And hopefully sellers are working more with those buyers to be able to help them either toward closing costs or something, so they can get into a home. Where 6 months ago, last year, there was no inspections. The seller they called all the shots. They didn't have to fix their home. They didn't have to do anything. There was no inspections. And these poor buyers were just on the sidelines. So this has made it hard because it's been a long run. I guess that's my point. It started in the beginning of 22. We went through all of 22. all of 23, and now we're in August of 24. They talk on the news of refinancing and take advantage of it. We're not there. Meaning maybe if your rate is 8 or 9%, you might be able to get into the mid sixes, which is great. My average loans interest rates are hovering between mid sixes and low sevens. For a lot of my clients are not in a position yet. It just doesn't make financial sense to go into and refinance and expense that money, right? To do it. Might as well maybe wait a little bit and get them positioned so they can take advantage, hopefully, of a rate in the fives.
Yeah, it's just wild. I think what you touched on historically blows my mind, right? I mean, we are spoiled in that rates are even at their highest, 7 or 8%. I can't imagine 15%. But to your point, there's also the other context involved, which is the cost of home values. So I appreciate that perspective because 2008 has always been earmarked as one of the worst we've, seen again in our lifetime. But this one is proving to be challenging for a number of other reasons too.
Yeah, I think a lot of people, what made 2008 different than this is you were talking a collapse almost of the mortgage industry, which it was scary. And this didn't start in 08, it started in mid 2006. So in 2006, we started seeing a bank here, a bank there, a subprime bank. All of a sudden, these entities were starting to shut their door. It really started going full force in probably early to mid 2007, where I would go into work daily and there would be another bank that had closed. So you had, in some cases, you had loans placed with these banks, and then all of a sudden you had to find a new home for them. And not all, of course, not every banking entity or whatever is able to do the same kind of thing that you had them, that they qualified for. So in some cases, you actually had to cancel the transaction, which was devastating to these poor people, right? So I think that, and then 2008, I think it then became just so globally known about how our banking system was almost, I hate to say it, almost collapsing. And I know that it was a very scary time, which is when I made my move from a company I had been with for 8 years. In April of 2008, I joined Northpoint Mortgage, and I've been with them since. So
something that's really prevalent in just my world, which you and I have talked about quite a bit, is the challenge with regards to unemployment, layoffs. That's something I would love to talk about as a bridge to my later questions here. But is that something you're also seeing too that's impacting a lot of borrowers? It feels like it's been 18 months now that people have been impacted by layoffs. As you know, Peter was impacted by a layoff this year as well. And there continues to be week after week people in my life who are impacted by layoffs. Has that also been something you've seen that's made a further challenge to the market we're in right now?
It's there, but I personally, myself, I have not had to have that happen. So I've had people, a week before closing decide they're going to leave their job and go somewhere else, thinking because they had a clear to close on their loan that they're free to just say, oh, okay, it's all done. I could just go and get a job somewhere else that I like better, I've been waiting for. But to have layoffs, no, it hasn't really directly affected myself.
Well, touching on what you mentioned about that borrower who decided to make a big job transition at a very critical threshold moment, as you know intimately well, I decided to leave my full-time W-2 position last summer to go out on my own. And I was well aware of, for lack of a better word, consequences of that, which is the lack of ability to qualify for a mortgage for the next few years based off of income. And I would love to talk about that because there are so many people in my life who are very curious about working for themselves. There's a lot of romanticism around it. Let's peel back the layer of that romanticism a bit and talk about some of the logistical considerations people should have before they do that. So what is advice that you have for people before they decide to go out on their own and start their own business?
Okay. Let's say they're renting and they have this fabulous job, they're tired of it, whatever, and they want to go out on their own. And they know that the income will come in, it's just not going to happen for a while. Well, first of all, if you're self-employed, you have to file 2 years of tax returns. And they have to be filed. It can't mean that you just work that job for 2 years. So depending on when you exit in that year, it may be that you have to be closer to 3 years, right? And file those returns. And obviously you want to make money. So we all know generally on a startup company, that first year you're writing off a lot. You've got setup costs, attorney fees, equipment if you need it. Even if you work as in IT, you still have to have great equipment to work with, and it can be many thousands of dollars, right? So the best thing to do is if you were thinking of either sizing up in a home or purchasing a home, you should do that 6 to 9 months earlier and have the ducks in a row, because you can get into a home. First time buyer, you can get into a home with as little as 3% down. In some areas, depending on where you live, it can be as little as it can be zero, right? So let's just go off the present 3%. Take a look at your finances and then make that plan to go ahead and buy. Because once you buy and you're in your home, then doing your exit, giving your notice and transitioning, you're fine. You're safe, as long as, of course, you can make that mortgage payment. But if you wait too late in the game, because a lot of times it can take months, especially if you are putting so little down, and we are in an aggressive market, it could take 2, 3, 4 months to find that home after, being on the search for it. So that's what I recommend, is really being smart about your planning and you're exiting from a W-2 job.
Yeah. And that's great advice. So 2 years of tax returns filed to qualify, and you need to have been profitable. You need to have made money.
It does, because if you think of your first year of writing off so much, that profit's probably very little. So then they're going to look at the second year. There also some of the underwriters can go back and say, okay, you're in the same field, right, that you were working as a W-2. Let's just say you exited your job in, like yourself, June of 23. Okay. They may say, well, show me your W-2s for 22 to show in that same field, what were you earning? So they understand your first year self-employed, that you're going to be writing off and taking that loss. So they're going to look at 24, but they're still going to average, because you don't have greater than 5 years being self-employed. They're going to take a look at those 2 years and they'll average it out. So if you suffer a loss and say you wrote off everything that you could, you have a great accountant writing everything, and say you showed a loss of $25,000 for your first year, and then the second year they write it off significantly, that's going to hurt you, because when you combine the two and you have a loss and then you have low profit for that second year, you still might not be able to qualify for a home.
Yeah. What about for people who have maybe a lot of cash stored in the bank, but you don't have the income to qualify, but you are looking at a primary? And then I would love to get into investor opportunities here. But what about for a primary residence? Is there creative ways that you can look at borrowing maybe more, like less money, putting more substantial down payments to be able to qualify? Is that something
you still have to qualify? So Fannie, Freddie, who underwrite, like, I don't know, I'm throwing a number out here, but say they underwrite 80% of the mortgages in this country, right? And what they mean that all entities like Fannie and Freddie, they have guidelines, and all servicing and lenders and banks underwrite according to those standards, right? Because ultimately it's Fannie and Freddie in most cases that are buying those loans, and then they send them out to servicers who's going to service that mortgage going forward. So that kind of leads into where you don't have 2 years of being self-employed, or you have more than two years or more, but you're not making the money, you can't show it. Then we have other investors that we have special programs. One of the programs, if it's a primary home, we could look at doing a bank statement program. It's pretty cool. So we have investors that'll go back. So you have to show that you're 2 years self-employed, and they will take a look at your business banking for 12 months. So they either have a 12-month program or a 24-month. And then what they do is they add up all your deposits. And then they take in factor of an expense that they use, they allocate. And it gives you your monthly income that they'll go off of. These loans are pretty cool because you can get in for as little as 10% down. You can, like I said, just go off bank statements for your primary home. And it's again, deposits a source, like anything. It sounds super easy. It's not as anything, right? You got to qualify. They take a look with a fine tooth comb at what you're throwing into those accounts. They want to make sure you're not borrowing from so-and-so, but you can get a gift. So you can buy using these programs. You can put as little as, say, this bank statement program, 10% down. The money can all be a gift. You're using the deposits out of your business account to qualify. And with a score of, I believe, a credit score as low as 660 can get you into that home. Now, the higher your credit score, and say you put a little bit more money, the rates are going to be more favorable. But expect interest rates, if right now an average rate on a home is, say, in the low sixes, let's just throw a number out. Maybe they're 6.25, 6.5. On a loan that you might be at 8%. Because again, there's not necessarily, there's a little more risk for the investor, but again, it's outside the box of a conventional mortgage. Yeah.
Got it. Well, with that in mind, speaking of other non-traditional loan programs, what about for investors? Because I do think entrepreneurs who are considering or who are already working for themselves have thought of real estate as an opportunity for them to diversify their portfolio. What are options afforded to them who do not want to go the traditional conventional loan route?
Okay. So on investment properties, we have a loan called a DSCR, which stands for your debt service coverage ratio. So these DSCR, it's a pretty simple formula. What they do is they use 100% of the rent. The rent is determined on that property by the appraiser. So how you would qualify is you would do an application. Your income is not listed. Your credit is pulled. They go off your credit score. They take a look at what your principal, interest, taxes, and insurance are. And then they take that and they divide it into the rent. So let's say you're purchasing a two-family. And that two-family, you're paying, I don't know, probably $650 for that two-family. You put 20% down. With that loan size of a little over $500,000, let's say that the payment with principal and interest, taxes, and insurance are going to run you $4,000 a month with those four things. And the rents on the property come out to being $4,100 a month, determined again by an appraiser. You're fine. That's all you qualify on. So you're qualifying on the monthly payment versus the rents collected, and you have a loan, which is pretty cool. So again, the ideal program is for those self-employed. You're flush with cash. You just can't qualify. So you can turn around again, 20% down. Now in some of these cases, you can do again as little as 10% down to buy, but or 15%, forgive me, 15%, but the rates are higher, but they're not hateful. I mean, these rates are like in the sevens. And they also have programs where with this DSCR loan, you can buy an Airbnb. So what a fabulous thing is, especially how popular they are, you could turn around and say, you're starting your company or you're a couple years into your company, you still don't qualify to go the Fannie Freddie route to buy that Airbnb, but you can do this program. So there are nice that they have avenues. So you're not stuck, not being able to take advantage of what's being offered out there.
So can it only be on multifamily, or could you buy a single family investment home?
You can buy a single family. So again, it's really where rents right now are pretty high. I just started one where it's a single family home, Dover, New Hampshire. The total payment was going to be $2,790, and the average rent that the realtor determined was between $2,800 and $2,900. So this was from somebody living out in California, wanting to buy an investment home, and it could absolutely work. All we had to do was, because she owned 4 other properties, we had to, of course, get mortgage statements and addresses on them. We also just qualified, again, with the appraiser and verifying the rents. Her credit was excellent. She had the assets and reserves. And that's a lot of things that these programs want. They're not designed for somebody that doesn't have money, right? They're designed with somebody that can put, ideally it's 20 or 25% down. And they can show like they have 12 months of reserves. And the reserves are based on the principal, interest, taxes, and insurance. So let's say, again, that totals $4,000. They'd like to see that you have $24,000 in some sort of an investment account, just as a cushion.
Wow. No, that's really interesting. Is it something where I know when you do an owner-occupied investment property, that was something I remember talking to you about years ago.
Yep.
You have to live in the property for at least a year to show that it's truly owner-occupied before you could move on and move out. Is there a similar clause to this as well, where you can't move into the property for X number of months or years, so that you're not getting, the sort of benefits of living in a primary with going this route with an investor property in mind? Is there some contingency there?
No. So I guess to make my understanding of what you're saying that you could own a home and you're buying an investment property, but you're saying that you want to exit from the home you're currently living in to move into the investment property and then maybe sell your home. You can certainly do that and then if you had, the reserves of that sale, you could apply it to the house that you bought originally as an investment. But from my understanding, there is nothing that prevents you from moving into that property. It's just typically that's not done, but doesn't say you can't.
Got it. Well, I just didn't know too, because again, a lot of times people will get into a situation and then they change their mind or something. So I didn't know if they purchased it as an investment, let's say for an Airbnb. Airbnbs aren't always booked out months and months in advance. So let's say 3 months in the property, they decided, we actually want to live there as our primary. Would they be able to do that, or would that be frowned upon because they bought it as an investment property?
No, you could certainly do it. Because you do, even though the bank technically owns the house, you can still do that. It's more that you bought it as an investment. What you choose to do with it after is really your business. But typically on that, you are paying, it's more expensive than a typical investment property, right? If you were going the conventional route and being qualified for all your income, et cetera. Yeah.
Got it. Well, this has been really interesting. I think this is great advice for both people who are considering a primary residence. If they should, be interested in purchasing something, do it before they go and make the leap and go out on their own. And then for people who are thinking of investment properties, and even for people who maybe do have to your point, maybe they don't even want to show what they have or have to go through the rigmarole. They're happy to go this non-conventional route to be able to avoid some of that combing through their assets or things like that. Maybe it's less aggressive in that way.
Yeah, because what happens is to say that it's not so much if you have just your primary home and you're buying an investment property, but if you own multiple investment properties, say, the conventional route is that you need to show us your tax returns. So that's one thing, right? You're showing tax returns. We have to look at the Schedule E that you're posting any of your investments on. We don't give 100% value for your rents. We look at the Schedule E, and then there's a formula that we use to break down what we can actually give you credit for. So a lot of times people are saying, well, my mortgage payment's $1,800. I'm collecting $3,000 for rent. So I am in the positive. But let's say they did some massive renovations and they wrote off and their net is not showing that. They're shocked sometimes that they could actually show a loss on that property. So when they're carrying a loss on top of their primary home, on top of their liabilities already reporting on their credit, it can get messy, right? And then that's where they might be forced to qualify to put more money down, or they simply don't qualify. So this DSCR program takes all that off the table because we're not looking. All we want to do is make sure we get the mortgage statements on the other properties. But we're not looking to analyze what they make. So it's very good. It just removes so many layers, I should say.
That's very cool. Well, like I said, I really appreciate that perspective. It's not the world that a lot of people live in, or these programs are not made very readily accessible with going to Dr. Google. So I think this is great information.
Yeah.
My last question for you today to wrap up is as we move really closer to the end of this year, what are you most excited about?
It's been, as I said, there are times that it's been extremely quiet. And I personally thrive on being busy. I love connecting with the people and the conversations that we have. I also love the fact that in a lot of cases with refinancing, you can change somebody's life. And by doing that, we're paying off debt. We're making it easier for them to breathe. They're able to capitalize in some of the equity of their home and be able to then stop worrying about what's happening in their life. And that brings me a lot of personal satisfaction to helping people.
That's great. Well, and like I said, I'm so grateful. I think you've already helped a lot of people in your life. I mentioned hundreds. I don't know the number of people you've already helped, but you've certainly helped me in more ways than I could ever enumerate here. But through guiding me and others today on what opportunities are afforded to them, because I think a lot of people have tremendous gifts and they want to share it and talents with the world, and being able to know what is afforded to them so they can navigate the journey the way they want to. So, Mom, thank you so much for joining me today on Cupalo Conversations and for sharing your insights.
Sweetheart, thank you so much for having me. This was such a pleasure to be here, and I'm honored. Thank you.